Welcome to Captains of Industry. Now we're living in a post-credit crisis world, and as some deliberate as to whether or not there are threats of a double-dip recession, others are more optimistic. Just this last year alone, over $1 billion has come into Africa through private equity vehicles. Africa is hot, Africa is hip, Africa is happening. And to tell us why that is the case, we're joined by TshepoMahloele, who's the CEO of the Pan-African Development Fund, Harith. Thank you very much for being our guest on Captains of Industry. Now, I've painted a very vibrant picture of investment post-credit crisis, but there are still challenges that remain, aren't there? Africa is a continent with 23% of the world's landmass. Almost 1 billion people live in Africa. Pre-credit crisis, we constituted a sixth of global GDP, and yet there is a sense that investors are wary of the continent. Why is that?
I think maybe it's a combination of issues. It's not just one issue. We know, I mean, Africa has had its issues. We've went through different periods, but I think the time in which we are, if you look at 5 years, maybe 5 years ago, where the continent was, where the continent is today, and maybe perhaps if we can manage to discount, you know, the financial crisis we had, and you look at what Africa was performing like before that crisis, and perhaps we take that picture and we project it 5 years ahead. I think we're very bullish about the continent, and also it's also borne out by the fact that, as you said, there's private equity money coming into the continent. I think when you see private equity going, they say you follow. And that's the way we sort of see. There's a lot of opportunities. It's one of the last frontiers. That's what we think.
All right, the difference between private equity and public equity, because we've seen some interested in indigenous, organically grown African companies that are publicly listed entities. But private equity requires a bit of a hawkish eye, identifying those jewels that others don't quite see, those rough diamonds. And so it needs a little bit more work. So there isn't the luxury of coming into Africa through a state-sponsored vehicle such as the Chinese do in their investment strategies. You've got to be a little bit more gung-ho. And is that why people are a little bit sketchy and testing when it comes to Africa?
Another thing we must do when we talk about Africa, we're talking about 58 economies, including some of the islands on the side. We're not talking just about one country, and maybe that's a bit of the challenge that what people maybe don't see. But also within that, there's pockets of serious excellence which are developing. But from an attitude point of view, I think it also goes about knowledge of the continent. You need to do private equity, from drawing on funds from some of the investors that you have, and then go and put it in some of these companies. You need to be on the ground. You need to know the promoters. You need to know what the opportunities are. You need to be able to manage the risk. You need to know, understand a whole lot of factors than just to come in with public sort of money, maybe some of the Chinese sort of funds are doing, but if you look at what they are looking at and also what other private equity money is also looking at, I think it's two different sort of investment models that they have. The sort of Chinese model is tending to focus on resources, on getting resources to the port, on sort of supporting Chinese entities, whereas other general private equity firms or private equity, capital is much more broad-based, and it will look at much more broader in entities than just that narrow focus of maybe just supporting that.
Let's talk about pricing Africa's risk, because that's been a hot topic of debate post the credit crisis. And I'm just going to break it down into various elements of risk. There's the perceived country risk, where you're looking at political stability issues, you're looking at the vibrancy of industry, the regulatory policy, fiscal management. You're looking at stability of labor issues. How do you assess country risk as private equity investors?
I think and that's where we tend to think that maybe as African-based, private equity fund manager, perhaps it gives us a bit of an edge over some, because Risk is, I think, is much more multidisciplinary than just the country, just the, the sector. You need to be able to know what is happening in country. What's the regulation, who are the promoters. And in our sort of like industry, it's, a large part of that has to do with the sponsors, the promoters, who you're getting into partnership with, who you are funding. Are these the type of people that, like, who can be able to get into a partnership with, and then, like, and have proper governance structures with them and do all those things. So it's we take a much more holistic view, and we also have people on the ground. We have an office in West Africa. We have an office in North Africa. That tends to enable you to develop the local knowledge to manage that risk much more closer, perhaps, than an outsider would do.
Others have looked at currency risk, for instance, and we know that although Africa doesn't have many tradable currencies, there are others that you can use as a benchmark, the Rand being one of them, the Naira being another one of them. And what we've seen with the volatility of the shilling, the Rand, the Naira, has less to do with local and domestic factors and more to do with the fact that sovereign debt issues in Europe, for instance, have led to a flight from the dollar, from the euro to the dollar, where the dollar and America's debt didn't seem to be manageable. There was a move to emerging markets. And so all of a sudden that globalization we talk about became quite tangible in African terms. How do you assess African currencies for investors coming in?
I think we have to accept that the volatility is something that we're going to have to live with for a while, and perhaps for much longer than what people believe that there will be. And with a much more globalized world, and Africa becoming more and more part of that, by the day, by the month, we will have to live with that. It's issue, how do you manage that? What we do, I mean, we're a dollar fund, but we will invest in, like, in all sorts of, like, regions from we'll also, and in most of our projects, you'll find that, especially when you look at infrastructure, the concessions become, they are in dollar terms or they're in euro terms. Like, even now finding more and more that some of the, concessions being priced in euros as even opposed to dollars. So even Africa will just get caught up within that whole, volatile environment. I mean, it will be affected by what happens in Europe, will be affected by what happens to the dollar. But I mean, and it's how you manage that. But we found that many of the, especially on the infrastructure side, which is where we focus, the concessions have become very much dollarized and that. But we price in for the a certain appreciation, depending on what currency we're talking about, or a certain depreciation over time, depending on what currency we're in.
Judicial issues, and here we're talking about vitriolic comments about nationalization, concerns about property rights in Africa, concerns of political interference in the judicial processes, the independence of the judiciary in many African countries. Is that a wrong or a right perception? How do you navigate the legal frameworks that exist across Africa? Because you've got everything from French law being applied to British law being applied to a hybrid of Dutch and British law being applied across the regions in Africa.
What you'll find happening in most instances, Lerato, is that capital will go where it's welcome. Capital will go where it's welcomed and where it's treated well. And you'll find that in economies or countries wherein there's where the leadership is very much aware of those issues, you'll find that projects will get done. That the issues of legal risk and all that, people will feel comfortable with. The issues that looking at the entire I think there are far fewer places than what perhaps the market makes out to be where there are those challenges. You'll find that there are many instances where, as you say, we'll use English law to structure certain contracts. We are involved in a couple of cross-border transactions, and we get into and we use English law, or we'll use maybe a jurisdiction which will tend to accommodate everybody So that's how we tend to manage those. But from a legal point of view, you'll always find that there are places where there's challenges, but there's many more opportunities where those challenges you manage them. And if you look at also history and you look at what the data is in terms of projects, and I want to focus much more on infrastructure rather than, let's say, pure private equity. And you look at some of the projects that entities like the African Development Bank and the World Bank has invested in. I think you won't even get a handful of projects which have failed on that side because of they are well structured. They are just as well done as projects in the West.
All right. I introduced a statistic earlier on that said that about $1 billion has come to Africa post the credit crisis. And I know that for many players in the private equity space, it's a bit of a debatable statistic, and you're one of those. What's your view?
Okay. I think if you look at up to 2009, how many funds closed? I can only count about one or two. And of those that closed, they were not just purely Africa-focused funds, they were more emerging market funds. And to say that $1 billion funds are closed, which also, it's maybe from a marketing point of view, it makes sense to say that, but then I think the reality is that some of the funds, the bigger funds which closed last year, were those which were more spread across different emerging markets, and Africa is just a portion of that. And you'll also find that Africa is a much smaller portion of the total of that thing. But there were one or two which closed, which were not entirely just African focused. It was a very difficult fundraising environment, and it remains one.
Let's talk about the environment today. As you're saying, it remains one. There are only about 4 stock exchanges in Africa that have a market capitalization over $50 billion. It's difficult for companies wanting to raise money over $100 million to do so in Africa, for instance. So liquidity is a challenge. Liquidity is compounded by the credit crisis situation we've just emerged from. So what innovative strategies are needed for raising capital today?
I think that's exactly true what you're saying, and I concur with that. And I think that's where perhaps private equity should get much more focused than the public listed markets with regards to capital raising and issues of tradability and issues of how much those stock markets in themselves can take. If you look at perhaps, let's say, 3 examples, even one of the biggest ones, South Africa, and you look at entities perhaps the Government Employees Pension Fund, what percentage it is of the Johannesburg Stock Exchange. You look at Botswana. What percentage can the Botswana Pension Officers and Pension Fund take up of the Botswana Stock Exchange? It would just overwhelm everybody. It would just push prices up, and that just tends to empower the existing equity holders, because it can just go up because they can't take their money elsewhere. And that's where I think private equity should play much more of a role. And that's where I think some of the pension funds and some of the other sovereign funds should maybe take in terms of helping Africa. We need much more debt, private capital, which can support indigenous, businesses to grow, and which are much more, they know the markets better. They are in those countries, and I think that will much more better enhance the situation and build up other economies. And it should actually enable them to take a much longer view of the continent or of the country than what perhaps the listed markets do, because listed markets, they come in, they go out as they please. It happens also in South Africa, but then I think the continent needs a much more longer term view in terms of the capital that comes in and that stays.